Ever feel like you're playing checkers?
Yeah.
Warren Buffett is over there mastering 4D chess.
Yeah, he's always a few steps ahead.
Well, today we're going to take a peek at his board.
Oh, this is going to be good.
We're diving into some of his recent moves, specifically a huge sale of Bank of America stock.
That was a big one.
And a growing appetite for the insurance giant, Chubb. So, buckle up. This deep dive into high finance might just give you some ideas for your own portfolio.
It's fascinating, because Buffett isn't just playing the market.
Right.
He's shaping it.
Yeah.
His decisions can send ripples, throughout the entire financial world.
Absolutely.
So understanding his strategy, it's like having a cheat sheet.
Yeah.
Albeit a complex one.
Exactly. And our source for this deep dive is a recent Molly Fool article.
Okay.
That really breaks down these two major plays.
Cool.
So let's start with the Bank of America situation.
Right.
Buffett's been steadily offloading shares since July.
Yeah.
A whopping 266 million shares, to be precise. That's 26% of Berkshire Hathaway's holdings in the company.
Yeah.
That's over $10 billion worth.
It's a lot, even for him.
It's a lot.
A lot.
It's a move that has a lot of people scratching their heads.
Right.
Because Buffett is known for his buy and hold philosophy.
Yeah.
So this sell-off begs the question, why the sudden shift?
Why now?
Yeah.
Why now?
The article dives into a few possible reasons, and some are pretty intriguing.
Okay, let's hear it.
So let's start with the tax man.
Okay.
Remember, Buffett himself predicted rising corporate tax rates earlier this year?
Yeah, I remember that.
Could this be a strategic move to lock in gains before those rates climb? Almost like a preemptive tax maneuver.
Yeah, it wouldn't be out of character for him.
Right.
He has a real knack for minimizing his tax burden.
Yeah.
But it's not the only explanation. The article also points to the market's current valuation. The S&P 500's Shiller PE ratio?
And for those unfamiliar, this is a metric that smooths out short-term earnings volatility for a clearer market picture.
Yeah.
It's sitting at a historic high right now.
Wow.
So this could be a signal to Buffett that the market is overpriced and due for a correction.
So it's like time to cash in some chips before the house cleans up.
Precisely.
Yeah.
Classic risk management strategy. Of course, it's important to note that even after this massive sale, Bank of America remains Berkshire Hathaway's third largest holding.
Okay.
This isn't a complete abandonment,
Gotcha.
but rather a strategic rebalancing.
Right, so it's not like he's writing Bank of America off completely.
No, not at all.
But there are other factors at play here that could explain his shift.
For sure.
Like one key factor is how Bank of America's, intrinsic value has shifted over time. Remember back in 2011, Buffett was drawn to the bank?
I do.
Because their stock was trading at a deep discount.
To their book value.
Huge discount.
Which is essentially the net worth of the company.
Right.
It's a classic value play. But the landscape has changed. Bank of America's stock is now trading at a premium to book value. So while it's still reasonably priced, the bargain that initially enticed Buffett just isn't there anymore.
The allure has faded.
Yeah. And then, of course, there's the elephant in the room.
The big one.
Interest rates.
Interest rates, yeah.
Ah, yes. The ever-changing interest rate landscape.
Bank of America's profitability is highly sensitive to interest rate fluctuations.
Yeah.
They've been riding high on the wave of rising interest rates, which have boosted their interest income significantly.
Right.
However, with the Federal Reserve, hinting at easing rates, that tide might be turning.
Meaning their interest income could take a hit.
Exactly.
And this is where Buffett's legendary foresight might be coming into play.
Yeah.
He's likely anticipating these potential headwinds and adjusting his portfolio accordingly.
It's a powerful lesson for any investor, We can't just set our portfolios on autopilot.
Right.
We have to adapt to the changing market winds.
Yeah.
Just like a skilled sailor adjusts their sails.
So for our listeners, the big question is, does this change your perspective on Bank of America as an investment?
Good question.
Maybe it's time to reassess your own holdings.
Yeah.
And see if they still align with your investment goals.
Absolutely.
Yeah.
But remember, every investor's situation is unique.
Of course.
What works for Warren Buffett may not be suitable for everyone.
Right.
The key is to understand the principles behind his decisions.
Yeah.
And apply them thoughtfully to your own circumstances.
Great point. Now let's flip the coin and look at where Buffett is putting his money.
All right.
Chubb, a major player in the often overlooked world of property and casualty insurance.
Interesting. And this is where we see another key tenet of Buffett's philosophy in action. His love for businesses with predictable cash flows. Insurance, especially in the property and casualty sector, fits the bill perfectly.
And Chubb isn't just any insurance company. This is a company that has seen its stock price explode.
Really?
Over 33,000%.
33,000%.
Since going public.
Wow.
Back in 1984.
That's incredible.
That's a track record of growth that's hard to ignore.
For sure.
And Buffett clearly hasn't.
Right.
The article outlines several reasons why Chubb might be so appealing to him.
I'd love to hear them.
And it goes beyond just steady cash flow.
Okay.
It's about the quality of that cash flow. With insurance premiums.
Yeah.
Provide a consistent stream of income.
Right.
And while individual claims are unpredictable, the overall pattern is remarkably stable.
Interesting.
This predictability is like gold
to
a long-term investor like Buffett.
Makes sense.
And then there's the added benefit of Chubb's premium pricing power.
Premium pricing power.
Which essentially means they can adjust their premiums.
Oh, okay.
To offset losses.
Oh, right.
From catastrophic events or higher than expected claims.
Interesting.
So it's like having a built-in safety net.
Yeah.
In a world where uncertainty is the only constant.
For sure.
This kind of flexibility
is
a huge advantage.
Right.
They can protect their profitability even in the face of unexpected challenges.
And this is further bolstered by their target market.
Okay.
Chubb caters to affluent clientele.
Right.
Whose spending habits tend to be more resilient.
Yeah.
To economic downturn.
Makes sense.
Meaning their premium payments
are
more reliable.
So they're somewhat insulated
right.
from the ups and downs of the average consumer market.
Exactly.
And then there's this whole float concept, right?
The float, yes, a fundamental concept in the insurance business.
Why?
It's essentially the money insurance companies collect in premiums,
okay,
but haven't yet paid out in claims.
Right.
This pool of funds becomes a powerful investment tool.
Yeah.
And in a time of rising interest rates, companies like Chubb can generate substantial income by investing their float.
It's almost like having free money to work with.
Yeah.
Talk about leveraging your assets.
That's the game.
And to top it all off, Chubb has a very shareholder-friendly capital return program.
Okay.
They consistently raise their annual dividend, putting cash directly in investors' pockets. And they've been aggressively buying back their own stock.
Buybacks are a fascinating strategy.
Yeah.
By reducing the number of outstanding shares, they increase the earnings per share.
Right.
And can often boost the stock price. It's a win-win for the company and its investors.
So Chubb checks a lot of boxes for Buffett.
He must love this company.
Predictable cash flow.
Yep.
Premium pricing power. A high-end client base.
Yep.
The added benefit of higher interest rates on their float. And a strong capital return program. It's no wonder he's been building up a significant stake. The question for you is, does this make Chubb a stock you would consider?
That's a good question. It's a $1 million question, right?
It is.
It all comes down to your individual investment goals.
Yeah.
And your risk tolerance.
For sure.
But understanding why a legend like Buffett finds a company attractive.
Right.
That's a great place to start your research.
Absolutely. And just to emphasize how much Buffett believes in Chubb.
Yeah.
Remember that between July of last year and March of this year, Berkshire Hathaway actually requested confidential treatment for their position in the company.
Oh, that's interesting. That's a tactic Buffett uses.
Right.
When he wants to accumulate a large position
without
attracting undue attention or driving up the price prematurely.
Yeah.
It allows him to kind of buy under the radar, so to speak.
Right.
Positions under confidential treatment, they aren't disclosed.
Right.
In Berkshire Hathaway's regular quarterly filings.
Oh, okay.
So it adds an element of secrecy to the whole thing.
So it was a secret stash of Chubb stock.
Basically, yeah.
But eventually the secret had to come out.
Right.
Their filing on May 15th revealed this hidden position.
Okay.
Which as of June 30th was over 27 million shares worth roughly $7.8 billion.
Talk about putting your money where your mouth is.
Right.
That's a serious investment.
It is.
And it clearly indicates Buffett's long-term confidence in Chubb's potential.
It's a stark contrast to the short-term, get-rich-quick mentality.
Yeah.
That drives so many investors today.
Absolutely.
Buffett's approach is a reminder that successful investing is a marathon, not a sprint.
It is.
He's always playing the long game, focusing on a company's fundamentals.
Right.
And its ability to deliver consistent profits over time.
And he's not swayed by hype or market noise.
Yeah.
He's looking for companies with a durable competitive advantage, a strong management team, and a business model that can stand the test of time.
Makes sense.
Those are the qualities that lead to sustainable growth and long-term value creation.
And both of these moves, selling Bank of America and buying Chubb, underscore the importance of recognizing value and keeping an eye on those macro trends. Because the factors that drive success in one market environment might not be the same in another.
Absolutely. With Bank of America, Buffett recognized that the bank's valuation had changed, diminishing its attractiveness as a value play. He also factored in the potential impact of shifting interest rates on their profitability. And with Chubb, he recognized the inherent stability and profitability of the insurance business, especially in a world grappling with increasing uncertainty.
He's also clearly drawn to companies like Chubb. With strong capital return strategies. Their commitment to raising dividends and buying back stock signals confidence in their future.
It does.
And a dedication to rewarding shareholders.
It's about aligning interests. When a company prioritizes returning capital to shareholders, it shows that management is focused on generating value for its owners, not just for themselves. That's something Buffett has always emphasized.
So we've examined two sides of the same coin here.
We have.
A legendary investor shedding one asset while piling into another. It offers a glimpse.
It does.
Into potential market shifts. And it highlights key investing principles like recognizing value, anticipating macro trends, and seeking strong capital return strategies. But what's the key takeaway for our listeners today?
It's tempting to try and mimic the moves of a master like Warren Buffett. But we have to remember, his context is unique. His scale of investment, his incredibly long-term perspective, and his access to information and opportunities are simply not available to most individual investors.
So we shouldn't blindly copy his traits.
Exactly. The real value is in understanding the underlying principles that guide his decisions and applying them to our own investment strategies in a way that aligns with our own goals and risk tolerance.
It's about learning from the master, not simply imitating him.
Exactly.
We need to think critically about our own investment objectives and make choices that are right for us, not just for Warren Buffett.
Precisely. And that leads us to a thought-provoking question for our listeners to ponder as we move forward.
All right, hit us with what's the brain teaser we're taking away today?
Well, we've talked a lot about Buffett's recent moves.
We have.
But here's something to consider.
Okay.
What if these moves are not just about maximizing returns, but also about strategically positioning Berkshire Hathaway for the future? What if he sees challenges on the horizon? Maybe a recession, maybe some kind of systemic shock. And he's adjusting his portfolio to weather those potential storms.
Ooh, that's a good one. It's like he's battening down the hatches. Preparing for rough seas ahead.
That's an interesting way to put it. And it makes you wonder, what does he see that we don't? What's he picking up in the market?
That's motivating these moves now.
It's definitely food for thought. And it underscores the importance of staying informed, doing our own research, and being prepared for whatever the future holds.
Exactly. We live in a world where things can change very quickly. And the ability to adapt and evolve is essential.
It is.
For success, both in investing
yeah.
and in life.
Yeah, it's like that old saying, the best time to plant a tree was 20 years ago.
Right.
The second best time is today.
Absolutely.
We might not be able to predict the future perfectly,
Nope.
but we can learn from the past.
Right.
And prepare ourselves as best we can.
And one of the best ways to prepare is to cultivate a mindset.
Yeah.
Of continuous learning.
Right.
The market is always evolving. New information is emerging.
Constantly.
And the companies that thrive today
might not be the ones that thrive tomorrow.
So we need to stay curious, stay informed,
right,
and be willing to adapt our strategies.
Absolutely.
As needed.
And that's what makes investing so fascinating. Yeah. It's a constant challenge.
It is.
A constant opportunity to learn and grow.
Right.
Who knows? Maybe one day some of our listeners will be making the kind of strategic moves Warren Buffett is making today.
Maybe amazing.
Shaping the market with their own strategic decisions.
Now, wouldn't that be something? Well, that brings us to the end of our deep dive into Warren Buffett's recent investment moves. Hopefully you gained some valuable insights into the mind of a master investor and picked up some useful tips that you can apply to your own portfolio. Remember, investing is a journey, not a destination. Stay curious, stay informed, and keep learning.
And don't be afraid to challenge conventional wisdom. Think for yourself.
Yeah.
Make your own decisions. After all, that's what Warren Buffett would do.
Words to live by. Thanks for joining us on this deep dive. Until next time, keep exploring the world of knowledge and ideas.